Hey guys, and welcome back to the Finance Now podcast. This podcast is purely for informational and educational purposes, and it's my way of sharing my knowledge, research, and opinions with you. I'm Anurag Birla, and once again, kicking off this week's episode with the macro debrief. So not much this week. I guess starting with the labor market, we saw continuing jobless claims come in at 1,955,000 versus the expected 1,960,000, and we saw initial jobless claims come in at 217,000 versus the expected 227,000. So both continuing and initial jobless claims coming in slightly better than expected. When we look at the housing market, which also serves as a good indicator of, consumer strength, economic certainty or uncertainty within the consumer or the buyer. We look at existing home sales, which was slightly lower than what we expected, 3.93 million versus the expected 4.0 million, and new home sales, which was also lower than what was expected, coming in at 627,000 versus the expected number of 649,000. So, new home sales were lower than the same time last year. When you look at supply has increased by 8.5%, suggesting that houses are staying on the market longer. And when you also look at the median sales price and how that's changed, it's lower than both the previous month and last year. So this combination of, supply increasing, sales lowering, and price also lowering kind of highlights the mismatch between supply and demand, right? It indicates perhaps weaker or more constrained buyers, which could either be due to high mortgage, high economic uncertainty, and in this case, possibly even both, and probably even both, right? The mortgage rate and the economic uncertainty. I guess the third bit of macro news or data that I wanted to kind of mention was Trump's deal, or the US's deal with Japan. And while the terms are seemingly agreed upon, there seems to be some difference in interpretations about the deal between the two parties, right? So just kind of skimming over what the deal is, it's essentially a 15% tariff rate that was set for bilateral trade, which includes Japanese automobile exports to the US, which is a significant reduction. This 15% tariff rate is a significant reduction from the threatened 25% rate. And there are no caps on car import volumes. Another point or key point within this agreement was that Japan agreed to a $550 billion investment into the United States to help bolster supply chains and key sectors like, semiconductors, energy, critical minerals, and advanced manufacturing. I don't want to get into too much more detail with this deal because we're not really sure who will hold up what end of the deal, especially around that $550 billion investment into the US. But it's just important to note that August 1st is coming in the next week, right? And the deadline for deals or for negotiations for a lot of the major partners was August 1st, unless Trump decides to extend it once again. Now looking at this, the countries that are yet to finalize a deal are the likes of India, South Korea, the European Union, Canada, Mexico, and Brazil, right? These are all major trading partners for the US. And, with this, I say that the uncertainty just doesn't go away, right? But the market doesn't seem to be fazed by it. I don't know if this next week we're going to see markets kind of react to this a bit more, maybe in the buildup of August 1st, but I do expect, or at least suspect, that there may be some volatility if these deals are not finalized in the next few days. Now, moving on to the juicy meat from the equity markets this week. We're diving deeper into earnings season, and I know, of course, Tesla and Alphabet are the two big names that reported, and I'll get to those a little bit later as a smaller part of the episode, because, today I mainly wanted to cover some other maybe smaller companies in terms of market cap, but more interesting names in my opinion, and most are names that I have spoken about previously. Well, all are actually names that I've spoken about previously. So I'd like to start, talking about ENPH. I've spoken about this solar home energy company before, ENPH Energy, on this podcast, and it's one that I like. It's one that I thought would be good to talk about the results of, especially in light of all the pain that the solar and renewable energy industry has been going through under this new administration. So revenue for ENPH came in at 363.2 million versus analyst estimates of 358.5 million. That's 19.7% growth year over year and a 1.3% beat against estimates. Adjusted EPS came in at 69 cents versus estimates of 62 cents. That's a 10.8% beat. Adjusted EBITDA came in at 77.19 million versus analyst estimates of 100.6 million. So that was where they missed, a 23.3% miss. And operating margin came in at 10.2%, which is up 0.6% in the same quarter last year. And sales volumes rose 9.1% year over year. So, overall, I think Q2 looked pretty solid, right? Q2 saw strong U.S. performance, with the U.S. international revenue mix being about 75-25%, a 17% increase in product sell-through, and a 3% increase in revenue. European revenue rose about 11% quarter over quarter, and this is despite the continued market challenges, especially with the macroeconomic uncertainty. Australia expected to resume growth due to a new government battery rebate, so that's good news there. I think the big headwind for ENPH remains tariffs, right? Q2 gross margins were impacted by 2% due to tariffs, and Q3 guidance assumes 3 to 5% gross margin impact from new tariffs, including the reciprocal tariffs on the likes of Malaysia, Vietnam. But I think product supply chain diversification and future battery technology are all expected to somewhat mitigate these effects further, at least according to company management. And if you look at the way they've guided for revenue for Q3 of 2025 calendar year, it's 350 million at the midpoint, below analyst estimates of 369.9 million. So significantly cautious, right? They remain cautious amidst the economic uncertainty and especially with the expiration of the tax credit. So I think this is why ENPH as a stock reacted so negatively to the earnings call. With ENPH, I think the company is looking to lead the way in the industry, especially through these tumultuous times, basically by expanding their lease and power purchase agreement financing, especially to smaller installers. So cutting installation and acquisition costs and doubling down on software and services like Solargraph and ENPH Care, right, which is their subscription revenue stream. They're also pursuing solid product innovation with new 4th gen batteries, their upcoming 5th gen battery, as well as their IQ9 microinverter, which are all expected to, somewhat increase energy density and energy capacity and lower costs, right? And the IQ9 microinverter is expected to launch in Q4. Again, higher power, 3-phase compatibility, and also hopefully targets new commercial markets. So I think there are a few things to look out for with ENPH going forward and a few things to be excited about, right? And these are their ability to expand and grow internationally or continue growing internationally, the speed and efficiency at which they're able to bring the new products to market, and their ability to, I guess, effectively focus on operational efficiency and how they actually manage their supply chain, right? All in all, it's a company I still like, and the market has fallen so out of love with solar energy and other forms of renewable energy. So ENPH has been a victim to this, I would say, cyclical change in mindset or thought process, but I truly feel like there's a strong opportunity here in solar, and especially with a company like ENPH that remains fundamentally strong in comparison to some of the other solar players. So I think if you're looking for a solar play, ENPH is a solid company. One I would argue is best in class for the industry. Now moving on to the next company I want to talk about, Intel, right? Just briefly going over what Intel's results were. Earnings per share came in at a loss of 10 cents per share adjusted, and revenue came in at 12.86 billion versus an estimated 11.92 billion. So revenue was a solid beat. Revenue came in above the high end of guidance, primarily driven by strong client and data center demand. Their non-GAAP gross margin was 29.7%. This was largely due to the 800 million non-cash impairment charge and a 200 million one-time cost, right? But without these one-time costs, the non-GAAP gross margin would have been 37.5%. So if we exclude these charges, that's what it would have come in at. In terms of guidance, I think Intel said it expects revenue for the third quarter of 13.1 billion, right, at the midpoint of its range, versus the analyst estimate of 12.65 billion. So guidance was actually stronger than what analysts were pricing in. And the chip maker said that, it expects to break even on earnings, while analysts were actually looking for 4 cents per share. So that was slightly lower. Revenue impressed, earnings disappointed, which I would argue partially caused the stock to fall about 12% for the week, which is a big drop. And I think another reason for the negative response was the cancellation of planned fab projects in the likes of Germany and Poland, and the consolidation of its testing and assembly operations in Vietnam and Malaysia. So CEO Lip-Bu Tan, who I spoke about being a fan of last quarter, added that the company would also slow down the pace of its construction of a chip factory in Ohio, depending on market demand and if it can secure any big customers for the facility. So what the problem with Intel has been seemingly is that the company invested way too much, way too soon, without any adequate demand. And this kind of curbing of expenditure is exactly what Intel need to be doing in order to be operationally efficient, right? This is exactly what Lip-Bu Tan came in to do. Tan also mentioned that the company had completed the majority of its planned layoffs, which amounted to about 15% of the workforce, so a sizable chunk. And he also mentioned that Intel plans to end the year with 75,000 employees. So, while the stock reacted negatively, I actually believe that the business is moving in the right direction. This sort of decisive decision making, in my head, it screams pretty basic corporate finance, in which you don't approve of projects that don't have a positive NPV, right? Clearly, without any anchor customer, Intel's foundry business does not need the kind of expenditure that it had been getting. And this kind of leaning out is exactly what Lip-Bu Tan said he aims to achieve. So for Intel, I'd actually argue, despite a 12% drop for the week, the quarter had a lot of positive highlights, right? And this one, and this is just one to continue to hold, right, as a stock, and perhaps even add on to now. I have strong beliefs that Lip-Bu Tan can turn things around here, and I think this has been a good start to what he intends on doing. And maybe it's one that I would perhaps look to add to the already sizable position that I have. Now, moving on to the third company I wanted to talk about, it's another company I mentioned last earnings season, which was ServiceNow. Now, contrary to the other two names that I spoke about, ENPH and Intel, ServiceNow stock actually responded more positively to earnings, right? Jumping about 7 to 8% after announcement, but over the subsequent days, it went back down just to end the week up about 1%. So looking at their results, earnings per share came in at $4.09 adjusted versus an expected $3.57. Revenue also came in higher than expected at $3.22 billion versus the expected number of $3.12 billion. Q2 subscription revenue grew 21.5% year over year in constant currency to $3.113 billion. This exceeded guidance by about 200 basis points. Operating margin was 29.5%, which is 2.5 points above guidance, and free cash flow margin was 16.5%, which is up 3 percentage points year over year. So very, very solid results. And, results were propelled by strong AI-driven products, right? Breaking that down a bit, Now Assist, their net new annual contract value beat expectations. We saw key AI Pro Plus deal count surge over 50% quarter over quarter, and the company, closed its largest Now Assist deal to date at over $20 million. This is, this strong AI-driven growth is no surprise, as their CEO, Bill McDermott, actually spoke about how every business in every industry is being refactored for agentic AI. Now, that said, ServiceNow not only beat earnings in a very solid way, but they also raised guidance. So a classic beat and raise. They raised their full year subscription revenue guidance by $125 million to the midpoint of 12.775 and 12.795 billion, which implies a 20% year over year growth. Q3 subscription guidance was between 3.26 billion and 3.265 billion, implying a 20 to 20.5% year over year growth. And their 2026 outlook targets over 15 billion in subscription revenue and 1 billion in Now Assist annual contract value. So, this is solid double-digit growth that's being guided from this company. And I think, a big part of this is being driven by, or is being looked at with continued margin expansion, right? Which is being driven by internal AI efficiencies. So their guidance for fiscal year 25 for subscription gross margin was 83.5%, operating margin was 30.5%, and free cash flow margin of 32%. All of these remain unchanged. And, they look to continue with ongoing investment in AI talent and technical sales, simply to capture this massive market opportunity that we're seeing. So I will say for a company like ServiceNow, while this company has been doing great and has been continuing to impress, right? My view since last quarter has not really changed. I love the business. I love everything that they're doing, but the stock continues to trade at a high PEG and forward PE. So for me, the question that comes into play is how sustainable is this growth, right? They're guiding for 20% growth, but with the way it's priced, there doesn't seem to be much room for a slowdown. In the case of corrections, I do think this is a company to keep an eye on, right? It's a good, fundamentally strong, industry-leading business, and if we see a slight hiccup here and there, but no fundamental change to the business, I think it would be a good one to open up a position in and get your hands on if you don't own it already. Now, moving on to the two companies that obviously attracted all the attention this week, right? Tesla, I'm just going to skim over because I don't want to spend so much time talking about this company. Musk has been in the news for a variety of reasons over the first half of this year, and honestly, it's just no surprise that Tesla's quarter was very, very poor. I don't think anyone was expecting anything else. I'm not going to deep dive into the results, but one thing I will say is that the value that Tesla is trading at now, despite the quarter that they had, and despite the guidance that Musk gave, or the warning, let's say, that he gave for volatile next few quarters, is not indicative of the strength of this business, right? Tesla at the moment is solely priced on their ability to achieve autonomy within their business streams, whether it's through their robotaxi or humanoid robots, which is their Optimus gig. Their entire value on the market is essentially contingent on them achieving autonomy. If you're holding this for the long term, then sure, maybe the stock will yield some benefit over a 5-10 year period, but do expect extreme volatility with the stock. It's just not a name I'd like to be buying at the moment. It's just not a name I'd like to be close to at the moment. I have my doubts on whether Tesla's advanced AI and camera-only strategy can actually close or overcome the sensor gap with LiDAR technology that a lot of the other self-driving vehicles use. But, other than that, I don't want to spend more time here. I'd like to just move on to the final company for today, which is Alphabet. To summarize their quarter, it was a solid quarter. They beat on both revenue and earnings. Their consolidated revenue was up double digits, 14% year over year to $96.4 billion, primarily driven by double-digit growth in search, YouTube, cloud, and subscription businesses. Google Cloud's revenue, which was a big highlight, grew 32% to $13.6 billion, and operating margin expanded to 20.7%. The biggest surprise, though, for me, aside from Google Cloud being so strong, their growth being so strong, the biggest surprise actually for me is search. I heard so much about how Google search is a dying business, but double-digit growth sure looks good for a supposedly dying business. AI continues to drive their product advancements and their momentum. You see the incorporation of AI in search, AI overviews, AI mode, and this has helped to drive higher queries, especially among some of the younger users. And I think Alphabet have also seen significant uptake in Gemini and video generation models like VO3 and Flow. Gemini now has reached 450 million monthly active users. Looking at YouTube, YouTube saw extremely strong revenue growth as well across advertising and subscriptions. Advertising up 13% to $9.8 billion and subscriptions up 20%. YouTube Shorts now actually generate comparable or higher revenue per watch hour to your traditional videos. And, YouTube Shorts average about 200 million daily views. Google Cloud demand, obviously the highlight, it remains strong with a backlog actually reaching $106 billion, which is up 38% year over year. One other surprising thing I should say was that Alphabet actually raised its 2025 CapEx outlook to $85 billion, which is an increase of $10 billion from their $75 billion previously mentioned. And this is mainly to meet growing AI and cloud customer requirements, right? And Alphabet also mentioned that they expect CapEx to further increase next year in 2026, while also noting that there will be ongoing supply constraints and increased depreciation. This is good news for the picks and shovel plays within the AI infrastructure industry, right? This is good news for chip companies, good news for data centers, energy companies, or any company that's somehow involved in the powering and completion of these projects. And I do wonder, with big tech earnings approaching this next week, I do wonder whether we're going to see an increase in CapEx from some of those players as well. Looking at, management's view of the remainder of 2025, I think Alphabet expressed high confidence in the ROI of their continued cloud and AI investments, which hopefully should give investors some peace of mind. I think what I was confused about, or the only thing I didn't understand post this earnings, is why the stock wasn't up more. It's great results, right? From what I believe to be the most undervalued company from the Mag 7. This is great results, and I think the only reason for Alphabet not jumping more is to do with the risks around regulatory decisions on search and the structuring of the company. I think once that's through, which I believe will be in August this year, we'll see more strong price action in either direction. I don't know if that'll be up or down. I can surely say that if it's down, I would like to be buying more of this stock. This remains a fundamentally solid business. Alphabet, I should say, remain a leader in AI. They remain a leader in data, search, advertising, and they have a lot of dark horse bets in their other businesses, such as Waymo and the robotaxi opportunity that Waymo produces, as well as some other bets in healthcare and some other high growth industries. That said, that kind of wraps it for today's episode. I would like to remind you that everything I say is not to be taken as formal investment advice. It's all purely my opinion and is intended for informational and educational purposes only. With that, I thank you for listening. I'm Anurag Birla, and this is the Finance Now podcast.